Hey, what's going on, folks? It's Dmitry back again. In this video, we're going to check out what are the tax benefits of real estate investments. Oh my god, man, it was fantastic when I started to learn about this and see what's going on and what happens in the world and of the real estate investment and taxes. But it was fantastic, such a fantastic sellout, I guess, for me, and that I've been I found out about those and all that happened. So by long story short, I wanted to share with you what I found out about it and see what's going on about in the tax things and then tax of what's going on there, what is available for the people. But again, not to go overboard, because I have one example in mind that with the gentleman that went overboard and kind of missed the opportunity and missed the chance and missed like the things that taxes can good for you or bad for things to be eligible for things. Anyway, so this is pretty much what I wanted to share with you about. And so like and subscribe down below. I hope you guys enjoyed this video, so let's go into it. So the first thing is depreciation, right? So what is the depreciation part? Obviously, as you buy a new house and new houses or properties, right? So just in general, everything has a depreciation time frame. If you don't know about depreciation part, in a nutshell, is basically a time. Basically, it just gets old, you know. In other words, things getting old, and nothing you can do about it. So that's pretty much one of the laws that we have in our world today. Actually, just whenever. Right? So, and they call it like basically a fancy word of depreciation, where you can actually financially quantify that as a thing going on. So, and that obviously deducted from the value of the property or whatever you have. So obviously you can do it throughout many things. Cars would be a good example, like a big cut, you know, or big in depreciation kick happens when you drive off the lot. You know, you sign up the papers, you drive off the lot, bang. It's like, I don't know, my guesstimate would be like 20% down right from the bat, boom, and you're out of 20% of value of your car. All right, so the reason to it is because you drove it. There you go. So I don't know what's the deal there, but it happens. So in any case, depreciation part is we understand the idea now, but how does it apply to the housing market and just properties and things like that? It's same way is because it's not same way as a car, but the idea is that it degrades in the value of a property, in the sense that things getting old. That's pretty much it. One good guy and mentor of mine, he mentioned that usually it takes about like 30 years for depreciation of a value of a house, and that's pretty much what I see sort of consistently throughout the dealings in the real estate market, in the real estate just in general. But what I can definitely say is that there is a certain period of time that life expectancy of a specific thing in the house can be sort of projected, so to speak, you know. But obviously new things, new technologies coming through, obviously that's matter, and that's subject to to readjust, so to speak, the analysis of there. But let's say, for example, a new roof, like new shingles roof and everything like that, will take about 30 years to depreciate completely, you know. So it's either rust, it's either not rust, but it's either moss or anything like that, but the weather, dirt, wind, everything, you know, you name it. So, and that's where depreciation comes in, and that's where you depreciate in the value. How it is beneficial? Well, so in the sense where you submit your taxes. And before I start and go all the way there, I'm not tax advisor, nothing like that. So if you take it as my a regular guy experience, and we're just sharing the good info for the betterment of the our understanding. But that's pretty much like I said, so not a tax advice. But anyways, So what I learned in that is tax depreciation, where you depreciate the asset of the, all the way through. Multiple strategies. I believe there's like a bunch of people who uses all the way to the top, or which is, I think, is kind of not good, because in the next year there are downsides of that, obviously, where you'll be able to qualify for additional property. So let's say you depreciate the asset or depreciate the house or property all the way through, and then you get to a point where you like, hey, you want to qualify for another house, but you got to a point in taxes where you're in minus, right? So that's where a mortgage agent or a mortgage lender will come up and say, you know what, bro, you are not qualifying because you're in the loss because of that. Like you got a minus, you got a negative on your tax prep, tax document. So you're out of luck. So out, basically. So, and like I said, so it's good to have a balance in those things. It's good to have depreciation, some sort of thing, but don't go overboard with that. So because you're obviously going to hurt yourself, or if you're in a position of not like growing your real estate asset portfolio, then it makes sense, go all the way to the top, because you obviously is not going to buy anything and things like that. So in the real scenario, in the real understanding, real estimates, you can qualify on that, I guess, but check with your tax advisor and actual professional. So 1031 exchange. 1031 exchange is one of the real good things that really sold me on the taxes. 1031 exchange, what it is basically, as far as I remember and know, is actually a tax code thing, like entry in the tax code, where there is a transition between. So basically, if you got many assets, many apartments throughout the county or whatever, throughout the area, and then you want to consolidate it basically in one or greater opportunity, like let's say you want to put it throughout the whole basically throughout the area, just in the one building, you sell all them out as a 1031 exchange, and then instead of taxing or taxation of the profit, you basically transfer it to another asset, which is all going to be another building, bigger, higher, whatever, so as much as you can buy, so it won't be taxed as a capital gains. That's pretty much that's the beauty of it, because the reason for it is because if you're getting taxed with the capital gains, you will be taxed in a higher, much higher rate. So, and I don't remember that tax, but that's as far as I understood the 1031 exchange part of the situation. So, right, and that's where it's a beautiful thing. Really encourages real estate investors to operate the money, operate the market and things like that, to do betterment, in the sense that if you kind of like develop the area. So I can see it in the perspective or on an example, like, hey, you develop multiple areas, places, and then you basically take all that accumulation of wealth, equity and everything like that, you obviously sell everything, put it in through 1031 exchange tool, you move it to another building that you can renovate, bring the value up, and then so you basically contributing and making the area better in that way. So very nice tool as far as I projection wise and utilization wise. Again, not tax advisor or anything, but I think to explore, and I haven't done it yet, but definitely seen and saw in my real life when I was closing the deal. The guy was like signing up the papers, and when they were doing the closure, they were confirming whether this house or this transaction will basically consider as a 1031 exchange later in the day. So, or basically will be considered that. So, and that's how it happened. Deductions, maintains, and like my notebook, as you probably guys noticed already. deductions in the sense maintenance, HOAs, and things like that. Obviously, as you bought them and in a business matter, in real estate matter, and things like that, some of the maintenance fees, taxes that you or not taxes, HOAs that you maintain, I believe you can utilize them as deductions. Tax advice has to be done with a professional. Confirm that 100%. And I also confirm it all the time, but unfortunately, human being human, I forget a lot, and that's pretty much what it is in this situation. So I forgot. So in any case, this is the one of those things that can be utilized and can be used as deduction methods as well. That's pretty much really like a high level of tools for the taxation. However, there are other tools that can be considered and divided into like kind of overlap. With the situation of the money and availability. So let's say refinance kind of situation where you are going to a lender and say, hey guys, I believe my real estate value is higher, I believe this, like, we can refinance. So basically you take a cash out refi, is that when the landlord giving you credit of the value equity that is in your property. So, and that's where you basically do refinance. You it's going to be in sometimes it's enclosed in the process as well, like the fees. Like I think my lender, I think he gave me like 5,000, 4,000, something like that for the closure, and it's for each property. So I believe that's where you need to understand, like, you know, obviously it takes money, obviously it takes all the process and everything like that, but if you want to take out, let's say 30 grand and then like have access to the 30 grand in liquid asset cash, then you can obviously depart from 5 grand because you're getting access to the 30 grand. So right, but again, those are not taxed, and that's pretty much what it is, right? So another way is to not avoid taxes, but you know, you're not going to be taxed on those anyway because it's technically considered as mortgage anyway. So it's a HELOC. That's what I used for purchasing my properties and things like that, right? So if money is, those are money considered to be as an asset or as a mortgage, because they are, right? So it's not avoiding taxes, not anything like that. So that's pretty much it. So tax benefits are there and I believe was for the purposes of encouraging people to, you know, invest, renovate, and bring in more better environment to the community, so that, you know, you just live a better place and better lifestyle, right? So that's pretty much my purpose for this video, is to introduce you guys to the idea of what it is, how it's beneficial, and how many tax advantages you can be utilized as a you know, to increase your value, to increase your profitability and things like that, so that the, you know, bring value to the end customer, so to speak. So I hope you guys enjoyed this video. It's a little bit kind of you know, educational, entertainment-y kind of thingy. So hope you guys enjoyed this video, because I certainly did. So because of the depreciation, what it is, how it looks like, what can be done. But again, I cannot stress it enough. Don't go overboard with it, because some people go and to tell you actually the story. So I almost forgot to tell you a story that I had a gentleman, and we spoke about it, things like that, which is going back and forth. But due to the businesses that he had, he basically depreciates everything. And I tell you, everything is everything. So all the assets, everything like that, which is, from a certain perspective, it says, it makes sense, right? You want to make a buck, you know, whatever, you know, if tools is there, why not to maximize the utilization, things like that. However, if you think about it, so as you depreciate everything, you technically can put as a tax return, an official document. You say, hey, you know what, I am in minus, I'm in loss, I'm And that's why I need this, I need this deduction, things like that, or my income can be considered as this. So, and if a mortgage lender sees, because they took usually 2 years of an analysis of your income, and they see like consistent low, consistent loss, consistent everything, so how can they in a good in a good manner, in a good understanding, give you in a good conscience, right, give you that loan or whatever. So right, so they're not gonna lie on applications or anything, so things like that. So it's kind of like two-way communication, two-way street, two-way work. So that's why it needs to be a proper way. So, and that's the end of story, is that the gentleman was kind of in a bad situation where they will not be able to qualify for anything, so, and that's why on the next tax statements, it's either go the same strategy, or change some income statement, because like future like this, or I believe you can change it on the backwards, but on the back tax returns or anything like that. But again, not tax advice. So throughout this video, I think hopefully you get one thing, is that go to a tax advisor. And even though I appreciate that you clicked on this video and looked at it and watched it all the way through, because this is the cherry on top that I told you the story about, that's where you gotta check it out with the tax professional, more better with CPA, right? Because CPA it's accountants and tax professional, things like that, certified and licensed, all that. So yeah, that's pretty much the video, and hope you guys enjoyed this video. So like and subscribe down below, right here somewhere, and yeah, I hope you guys enjoyed it. Let me know in the comments below what you guys want to talk about the finance, personal finance, and things like that. I know it's a huge amount of people out there, but the key here is that we're not selling anything, we're not trying to manipulate anything, we're just sharing what is in my heart. And yeah, that's pretty much, I want you to prosper and be in the good financial, having good financial habits, things like that. So sort of like that. So anyway, thank you guys again. See you next time. Bye bye.